Question 1. Process analysis reveals that an Alabama-domiciled insurer has a reinsurance contract in place for a large commercial policyholder. Subsequently, the insurer becomes aware of a significant development in the policyholder's operations that substantially increases the potential for a large liability claim, far exceeding the original risk assessment. What is the most appropriate and legally compliant course of action for the insurer to take regarding the reinsurer? Option A. Delay notification to the reinsurer until a claim is actually filed by the policyholder. Option B. Immediately notify the reinsurer of the material change in the policyholder's operations and the increased potential liability. Option C. Assume the reinsurer will discover the increased risk through its regular auditing processes. Option D. Provide the reinsurer with a general update on the policyholder's business without specifically detailing the increased liability. Correct answer is B. Immediately notify the reinsurer of the material change in the policyholder's operations and the increased potential liability. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an insurance company to navigate the complexities of reinsurance, specifically concerning the notification of a material change in risk. Alabama law, like many jurisdictions, places a significant emphasis on transparency and accurate risk assessment in insurance contracts. Failure to properly disclose material changes can undermine the foundational principles of the reinsurance agreement, potentially leading to disputes and financial instability for both the ceding insurer and the reinsurer. The professional challenge lies in correctly interpreting what constitutes a material change and ensuring timely and appropriate communication as stipulated by the reinsurance contract and Alabama insurance regulations. Correct approach analysis. The best professional practice involves promptly notifying the reinsurer of the significant increase in the insured's potential liability, as this directly impacts the risk profile assumed by the reinsurer. Alabama law, particularly as it relates to the duty of good faith and fair dealing in insurance contracts, implicitly supports such proactive disclosure. Reinsurance contracts are built on the principle of utmost good faith, uberrimi fidei, meaning both parties must disclose all material facts. A substantial increase in the insured's potential liability is undeniably a material fact that alters the risk assumed by the reinsurer. Failing to disclose, this could be seen as a breach of this duty, potentially voiding the reinsurance coverage or leading to disputes over claims payment. This approach aligns with the regulatory expectation that reinsurers are fully informed of the risks they are underwriting. Incorrect approach is analysis. One incorrect approach is to delay notification until a claim is filed. This is professionally unacceptable because it violates the principle of utmost good faith and the contractual obligation to keep the reinsurer informed of significant changes in risk. Alabama insurance regulations emphasize prompt and accurate disclosure. Waiting until a claim is filed deprives the reinsurer of the opportunity to assess the altered risk, potentially adjust its own reserves, or even decline coverage for future risks of this nature. This delay can be construed as bad faith. Another incorrect approach is to assume the reinsurer would discover the increased risk through routine audits. While audits are a part of the reinsurance relationship, they are not a substitute for direct and timely notification of material changes. Relying solely on audits for such critical information is a failure to uphold the proactive disclosure obligations inherent in reinsurance contracts and Alabama insurance law. This approach abdicates the ceding insurer's responsibility to keep the reinsurer fully apprised of evolving risk exposures. A third incorrect approach is to only provide a general update on the insured's business without specifically mentioning the increased liability. This is insufficient because it lacks the specificity required for the reinsurer to accurately assess the impact on its exposure. A material change requires clear and direct communication of the specific nature and magnitude of the risk alteration. A vague update does not fulfill the duty of utmost good faith and can lead to the reinsurer being unaware of the true extent of its potential liability. Professional reasoning. Professionals in this situation should adopt a framework of proactive risk management and transparent communication. This involves thoroughly understanding the terms of the reinsurance contract, particularly clauses related to notification of material changes. When faced with a situation that could potentially alter the risk profile of an insured, professionals should err on the side of caution and provide prompt, specific, and comprehensive notification to the reinsurer. This approach not only ensures compliance with Alabama insurance law and contractual obligations, but also fosters a strong, trust-based relationship with the reinsurer, which is crucial for long-term success in the insurance industry. Question 2. Stakeholder feedback indicates a growing concern among Alabama residents regarding the potential for sudden policy cancellations due to temporary financial hardship. Considering the importance of insurance in providing essential financial security and stability to individuals and families across Alabama, what is the most responsible and ethically sound approach for an insurance company when a long-term policyholder expresses difficulty in making their upcoming premium payment? Option A. Proactively explore all available policy options, such as payment plans, grace periods, or policy modifications, in consultation with the policyholder to maintain coverage while adhering to Alabama Insurance Code provisions. Option B. Immediately initiate the cancellation process for the policy to mitigate potential future losses for the insurer, informing the policyholder of the cancellation. Option C. Offer the policyholder a significantly different and less comprehensive policy at a higher premium as the only alternative to immediate cancellation. Option D. Proceed with cancellation and retain all premiums paid to date, citing the policyholder's failure to meet payment obligations as per the contract. The correct answer is A. Proactively explore all available policy options, such as payment plans, grace periods, or policy modifications, in consultation with the policyholder to maintain coverage while adhering to Alabama Insurance Code provisions. Explanation. This scenario is professionally challenging because it requires an insurance professional to balance the immediate financial needs of a policyholder with the long-term stability and fairness of the insurance market in Alabama. Misjudging the impact of a policy cancellation could lead to significant financial hardship for the individual and potentially set a precedent that undermines the principles of risk pooling and actuarial soundness that are fundamental to Alabama insurance law. Careful judgment is required to ensure that decisions are both compassionate and compliant with regulatory obligations. The best professional approach involves a thorough assessment of the policyholder's situation in conjunction with an understanding of the Alabama Insurance Code's provisions regarding policy rescission and cancellation. This approach prioritizes exploring all available options that maintain coverage while adhering to legal and ethical standards. Specifically, it would involve investigating whether alternative payment arrangements, policy modification, or grace periods are permissible under the policy terms and Alabama law. This is correct because it upholds the insurer's duty to act in good faith, seeks to preserve the contractual relationship, and aligns with the regulatory intent to protect policyholders from undue loss of coverage, provided the policyholder meets their obligations or reasonable accommodations can be made. The Alabama Insurance Code, while allowing for cancellation under specific circumstances, also emphasizes fair dealing and consumer protection. An incorrect approach would be to immediately proceed with cancellation without exploring any alternatives. This fails to meet the ethical obligation of good faith and fair dealing expected of insurers in Alabama. It also potentially violates provisions within the Alabama Insurance Code that may require insurers to offer certain options or provide adequate notice of cancellation, especially if the cancellation is due to non-payment where grace periods or reinstatement options might be applicable. Another incorrect approach is to offer a significantly less favorable policy as the only alternative to cancellation. This could be seen as coercive and may not align with the principle of offering coverage that is reasonably comparable or in the policyholder's best interest, especially if the insurer has the capacity to offer more suitable alternatives. Such an action could be viewed as an attempt to circumvent the spirit of consumer protection laws in Alabama. A further incorrect approach is to prioritize the insurer's immediate financial gain by canceling the policy and retaining unearned premiums without a thorough review of the policyholder's circumstances and applicable Alabama regulations. This disregards the societal importance of insurance as a risk management tool and the insurer's role in providing that security, potentially leading to regulatory scrutiny for unfair or deceptive practices. The professional reasoning process for similar situations should involve a systematic evaluation of the policyholder's request or situation, a comprehensive review of the relevant policy provisions, and a detailed understanding of the Alabama Insurance Code and any applicable administrative rules. Professionals should always consider the ethical implications of their decisions, aiming for solutions that are both legally compliant and demonstrate a commitment to fair treatment of policyholders, thereby reinforcing the vital role of insurance in providing financial security and stability within Alabama. Question 3. The risk matrix shows a growing emphasis on consumer rights and protections within the insurance industry. Considering the historical development of insurance law in Alabama, which of the following actions best reflects an understanding of how societal shifts have influenced regulatory frameworks and underwriting principles? Option A. Maintaining existing underwriting and claims handling procedures that have been in place for decades, assuming they are still compliant with current Alabama insurance law and consumer expectations. Option B. Adopting consumer protection standards from other states that have recently enacted more stringent regulations, without a thorough analysis of their compatibility with Alabama's specific statutory and historical legal precedents. Option C. Implementing policy review processes that incorporate recent Alabama legislative amendments aimed at enhancing policyholder transparency and dispute resolution mechanisms, while ensuring these changes align with established actuarial principles for rate setting and solvency. Option D. Prioritizing immediate customer satisfaction in all claim disputes, even if it means deviating from established policy terms and Alabama's statutory guidelines for claims settlement. The correct answer is C. Implementing policy review processes that incorporate recent Alabama legislative amendments aimed at enhancing policyholder transparency and dispute resolution mechanisms, while ensuring these changes align with established actuarial principles for rate setting and solvency. Explanation. The risk matrix shows a complex interplay between evolving consumer protection sentiments and the foundational principles of insurance underwriting. This scenario is professionally challenging because it requires an insurance professional in Alabama to navigate the historical evolution of insurance law, specifically how societal shifts have influenced regulatory frameworks, without compromising the core actuarial principles that ensure solvency and fair pricing. The challenge lies in balancing the imperative to adapt to modern consumer expectations with the enduring need for a stable and financially sound insurance market, as dictated by Alabama's specific statutory and case law history. The best approach involves recognizing that the historical development of Alabama insurance law has been a gradual process, often driven by legislative responses to market failures and public outcry, rather than a sudden overhaul. This evolution has led to a regulatory environment that increasingly emphasizes transparency, fairness, and consumer recourse, while still upholding the principles of risk pooling and actuarial soundness. Therefore, understanding this historical trajectory allows for a more nuanced interpretation of current regulations, such as those governing policy cancellation, claims handling, and rate justification, ensuring compliance with both the spirit and letter of Alabama law. This approach acknowledges that while consumer protection has become paramount, the underlying economic realities of insurance necessitate a measured and legally grounded implementation of new standards. An incorrect approach would be to assume that recent consumer protection trends in other jurisdictions can be directly applied to Alabama without considering its unique legal history and statutory framework. This ignores the specific legislative intent and judicial interpretations that have shaped Alabama insurance law over time. For instance, adopting a policy that prioritizes immediate consumer satisfaction over established underwriting guidelines, without a clear basis in Alabama statutes or regulations, could lead to financial instability for the insurer and potential violations of Alabama code provisions related to solvency and fair market practices. Another incorrect approach is to rigidly adhere to outdated practices that predate significant consumer protection reforms in Alabama. This fails to acknowledge the legislative and judicial evolution that has occurred, potentially leading to noncompliance with current Alabama insurance statutes and regulations designed to protect policyholders. For example, continuing to use policy language or claim settlement practices that have been deemed unfair or deceptive under Alabama law would expose the insurer to regulatory penalties and litigation. A third incorrect approach would be to interpret historical developments as solely empowering consumers without recognizing the reciprocal obligations and the insurer's need to manage risk effectively. This unbalanced perspective could lead to the implementation of practices that are not actuarially sound or financially sustainable, ultimately jeopardizing the insurer's ability to fulfill its obligations to all policyholders, which is a fundamental tenet of insurance law in Alabama. The professional reasoning process should involve a thorough review of Alabama's insurance statutes, administrative regulations, and relevant case law concerning the historical development of insurance law and consumer protection. Professionals must critically assess how past legislative actions and judicial decisions have shaped current requirements. This includes understanding the rationale behind specific regulations and their impact on both consumer rights and insurer responsibilities. When faced with new market trends or consumer expectations, professionals should consult legal counsel and regulatory experts to ensure any proposed changes align with Alabama's established legal framework and historical precedents, thereby fostering both consumer trust and long-term market stability. Question 4. Stakeholder feedback indicates a recurring concern regarding the application of insurable interest principles in life insurance sales within Alabama. An insurance agent is approached by a client who wishes to purchase a substantial life insurance policy on the life of a distant acquaintance, naming this acquaintance as the sole beneficiary. The client states they have a strong friendship and believe this is sufficient grounds for the beneficiary designation. What is the most appropriate course of action for the agent to take in Alabama? Option A. Recommend that the client purchase the policy and then, after issuance, explore options to change the beneficiary to someone who demonstrably has an insurable interest in the insured's life. Option B. Advise the client that a life insurance policy can only be issued if the proposed beneficiary has a legitimate insurable interest in the life of the insured, which typically requires a reasonable expectation of financial loss upon the insured's death, and explain that a mere friendship, without demonstrable financial dependence or loss, is generally insufficient under Alabama law. Option C. Proceed with issuing the policy as requested by the client, as the client is the applicant and payer, and the beneficiary designation is a matter for the policy owner to decide. Option D. Inform the client that the beneficiary can simply state they have an insurable interest on the application, and the insurance company will verify this later if a claim arises. The correct answer is B. Advise the client that a life insurance policy can only be issued if the proposed beneficiary has a legitimate insurable interest in the life of the insured, which typically requires a reasonable expectation of financial loss upon the insured's death, and explain that a mere friendship, without demonstrable financial dependence or loss, is generally insufficient under Alabama law. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires the insurance agent to navigate the delicate balance between client relationships and strict adherence to Alabama insurance law, specifically concerning the principle of insurable interest. Misinterpreting or overlooking this principle can lead to voided policies, financial losses for the insured, and potential regulatory sanctions for the agent. Careful judgment is required to ensure that the proposed insurance coverage aligns with legal requirements and ethical obligations. Correct approach analysis. The best professional practice involves advising the client that a life insurance policy can only be issued if the proposed beneficiary has a legitimate insurable interest in the life of the insured. This approach directly addresses the core of Alabama's insurable interest requirements, which generally dictate that a person must stand to suffer a financial loss upon the death of the insured to have an insurable interest. This aligns with Alabama Code Section 27-14-1, which establishes the necessity of an insurable interest at the inception of a life insurance contract. By explaining this legal prerequisite, the agent upholds their duty to provide accurate and lawful advice, protecting both the client and the integrity of the insurance transaction. Incorrect approach is analysis. Advising the client that the policy can be issued as requested, regardless of the beneficiary's relationship, fails to acknowledge and apply the Alabama insurable interest laws. This approach risks the policy being deemed void ab initio, void from the beginning, if the beneficiary lacks the required insurable interest, leading to claim denial and potential legal disputes. Suggesting that the beneficiary can simply state they have an insurable interest without further verification bypasses the legal requirement for a demonstrable financial loss. Alabama law requires more than a mere assertion. An insurable interest must be based on a reasonable expectation of financial benefit or avoidance of financial loss. This approach is ethically questionable and legally unsound. Recommending that the client purchase the policy and then later attempt to change the beneficiary to someone with an insurable interest is also problematic. While beneficiary designations can be changed, the initial issuance of the policy must comply with insurable interest requirements at the time of application. Attempting to rectify a fundamental legal flaw after policy issuance does not cure the initial defect and could still lead to complications. Professional reasoning. Professionals should approach such situations by first identifying the relevant legal principles. In this case, Alabama's insurable interest laws. They should then assess the client's request against these legal requirements. If the request appears to conflict with the law, the professional's duty is to educate the client about the legal constraints and explain the permissible options. This involves clear communication, adherence to statutory mandates, and prioritizing lawful and ethical conduct over immediate client satisfaction that could lead to future problems. Question 5. Stakeholder feedback indicates that some insurance agents in Alabama are not adequately clarifying the nature of term life insurance to clients who express a need for coverage for a specific limited period. Considering the Alabama Insurance Code, which of the following actions best addresses this concern and ensures client understanding and suitability? Option A. Advise the client that permanent life insurance is a superior long-term solution and steer them towards that product. Option B. Provide the client with policy brochures and allow them to independently determine if term life insurance meets their needs. Option C. Discuss the client's specific duration need. Explain that term life insurance provides coverage for a set period and will expire at the end of that term, and clarify the implications for renewal or replacement. Option D. Recommend the longest available term life insurance policy to ensure the client has coverage for as long as possible. The correct answer is C. Discuss the client's specific duration need. Explain that term life insurance provides coverage for a set period and will expire at the end of that term, and clarify the implications for renewal or replacement. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance agent to balance the client's immediate financial needs with the long-term implications of their insurance choices, all within the specific regulatory landscape of Alabama. Misinterpreting the client's intent or failing to provide adequate information can lead to significant client dissatisfaction, regulatory scrutiny, and potential financial harm to the client. The agent must exercise careful judgment to ensure the client's best interests are met while adhering to Alabama's insurance laws. Correct approach analysis. The best professional practice involves thoroughly understanding the client's stated need for temporary coverage, and then clearly explaining the features and limitations of term life insurance, specifically highlighting its expiration date and the potential for increased premiums or uninsurability if coverage is needed beyond the term. This approach directly addresses the client's expressed desire for a specific duration of coverage, while proactively educating them about the nature of term life insurance and its inherent limitations. Aligning with the Alabama Department of Insurance's emphasis on agent responsibility for client education and suitability. Incorrect approaches analysis. One incorrect approach involves immediately recommending the longest term policy available without further discussion. This fails to confirm if the client truly understands that term life insurance has a fixed end date and that coverage will cease unless renewed at a potentially higher cost or replaced with a new policy. This could lead to a lapse in coverage when the client still needs it, violating the principle of ensuring the client's needs are adequately met. Another incorrect approach is to push for permanent life insurance policy, arguing it is a better long-term solution, without fully exploring the client's stated need for temporary coverage. While permanent insurance may have benefits, overriding a client's explicit request for temporary coverage without a clear and compelling justification based on their stated financial goals and risk tolerance is a misrepresentation of their needs and a failure to act in their best interest, potentially violating Alabama's Unfair Trade Practices Act. A final incorrect approach is to simply provide brochures on term life insurance and let the client make the decision independently. While providing information is important, an agent has a professional and regulatory obligation under Alabama law to explain the policy's features, benefits, and limitations, and to ensure the policy is suitable for the client's circumstances. Leaving the entire decision-making process to the client without adequate guidance is a dereliction of duty. Professional reasoning. Professionals should adopt a client-centric approach, beginning with active listening to understand the client's stated needs and financial situation. This should be followed by clear, concise explanations of available products, focusing on how each product meets or does not meet the client's stated objectives. Agents must then assess suitability, ensuring the chosen product aligns with the client's risk tolerance, financial capacity, and stated goals, all while adhering to the specific disclosure and conduct requirements mandated by the Alabama Department of Insurance. Question 6. Cost-benefit analysis shows that a client in Alabama is seeking a life insurance product that offers guaranteed lifelong protection and a predictable cash value accumulation, but also expresses interest in potential for higher returns and flexibility similar to investment vehicles. Considering the Alabama Insurance Code's emphasis on accurate product representation and fair dealing, which approach best addresses the client's stated needs and regulatory expectations? Option A. Advise the client that the whole life policy can be easily surrendered for a substantial return in the short term, without fully explaining surrender charges or tax implications. Option B. Highlight the potential for higher cash value growth in the whole life policy by comparing it to market-linked investments, downplaying the guaranteed nature of its primary life insurance features. Option C. Focus on the commission structure and the agent's incentives for selling the whole life policy, without thoroughly exploring the client's financial goals and risk tolerance. Option D. Clearly explain the guaranteed death benefit and cash value growth of the whole life policy, detailing its long-term security and legacy planning benefits, while also transparently discussing its limitations regarding market-linked returns and liquidity compared to other investment options. The correct answer is D. Clearly explain the guaranteed death benefit and cash value growth of the whole life policy, detailing its long-term security and legacy planning benefits, while also transparently discussing its limitations regarding market-linked returns and liquidity compared to other investment options. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an insurance agent to balance the client's immediate financial concerns with the long-term benefits and guarantees of a whole life insurance policy. The client's desire for flexibility and potential for higher returns, coupled with a misunderstanding of the guarantees offered by whole life, necessitates careful explanation and ethical guidance to ensure the client makes an informed decision aligned with their actual needs and the product's design. Misrepresenting the policy's features or pushing a product solely based on commission potential would be a significant ethical and regulatory breach. Correct approach analysis. The best professional practice involves a thorough needs analysis that clearly articulates the guaranteed death benefit, cash value growth, and premium stability of the whole life policy. The agent must explain how these features address the client's stated need for long-term security and legacy planning, while also transparently discussing the policy's limitations regarding market-linked returns and liquidity compared to other investment vehicles. This approach ensures the client understands the fundamental nature of whole life insurance as a permanent protection product with guaranteed components, aligning with Alabama's regulatory emphasis on fair dealing and accurate product representation, as outlined in the Alabama Insurance Code, particularly concerning disclosure requirements and prohibitions against misrepresentation. Incorrect approaches analysis. One incorrect approach involves emphasizing the potential for higher cash value growth by comparing it to market-linked investments without adequately disclosing the guaranteed nature of the whole life policy's death benefit and cash value accumulation. This misrepresents the product by overstating its investment-like characteristics and downplaying its primary function as life insurance, potentially violating Alabama's Unfair Trade Practices Act, which prohibits deceptive practices. Another incorrect approach is to focus solely on the commission structure and the agent's personal incentives for selling a whole life policy, without adequately addressing the client's stated financial goals and risk tolerance. This prioritizes the agent's financial gain over the client's best interests, which is an ethical failure and could be construed as a violation of fiduciary duties or principles of good faith and fair dealing expected of licensed insurance producers in Alabama. A third incorrect approach is to dismiss the client's concerns about premium and flexibility and suggest that the policy can be easily surrendered for a substantial return in the short term, without fully explaining surrender charges, potential tax implications, and the impact on the death benefit. This misleads the client about the policy's liquidity and long-term commitment, potentially violating disclosure requirements and leading to client dissatisfaction and regulatory scrutiny under Alabama insurance laws. Professional reasoning. Professionals should always begin by conducting a comprehensive needs analysis to understand the client's objectives, financial situation, and risk tolerance. This should be followed by a clear, accurate, and unbiased explanation of suitable product options, highlighting both benefits and limitations. Transparency regarding commissions and potential conflicts of interest is paramount. In Alabama, adherence to the insurance code, particularly provisions on fair practices, misrepresentation, and disclosure, is non-negotiable. The decision-making process should prioritize client education and informed consent, ensuring that the chosen product genuinely meets the client's needs and expectations. Question 7. Operational review demonstrates that an insurance agent in Alabama has a client who has expressed a strong interest in purchasing a universal life insurance policy. The client, a retiree with a modest fixed income, has indicated they want a policy that offers some cash value growth potential. The agent has explained the basic concept of universal life, but has not conducted a detailed financial needs analysis or assessed the client's understanding of the policy's long-term funding requirements and potential for lapse if premiums are not consistently met. The agent is considering proceeding with the sale based on the client's expressed interest. What is the most appropriate course of action for the agent in this situation? Option A. Recommend the most expensive version of the universal life policy to ensure maximum cash value growth potential, as this appears to be the client's primary objective. Option B. Conduct a thorough financial needs analysis and suitability assessment to determine if the universal life policy is appropriate for the client's financial situation and objectives, and ensure the client fully understands the policy's features, costs, and risks before recommending or selling it. Option C. Explain the basic features of universal life insurance and then leave the decision entirely to the client, providing only minimal information to avoid overwhelming them. Option D. Proceed with the sale of the universal life policy as requested by the client, assuming their expressed interest indicates it is the right product for them. The correct answer is B. Conduct a thorough financial needs analysis and suitability assessment to determine if the universal life policy is appropriate for the client's financial situation and objectives, and ensure the client fully understands the policy's features, costs, and risks before recommending or selling it. Explanation. Scenario analysis. This scenario presents a professional challenge because it involves a client's financial well-being and the agent's fiduciary duty. The agent must balance the client's stated desire for a specific product with the ethical obligation to ensure the product is suitable and in the client's best interest, especially when the product's complexity and cost might not align with the client's apparent financial capacity or understanding. Alabama law requires agents to act with honesty and integrity, and to recommend products that are suitable for the client's needs and financial situation. Correct approach analysis. The best professional approach involves thoroughly assessing the client's financial situation, objectives, and understanding of universal life insurance. This includes explaining the policy's features, benefits, costs, and potential risks in clear, understandable terms and verifying that the client comprehends these aspects. The agent must then determine if the universal life policy is genuinely suitable for the client's specific needs and financial capacity, and if not, recommend alternative, more appropriate products. This aligns with Alabama's regulatory framework emphasizing suitability and the agent's duty to act in the client's best interest, preventing misrepresentation or the sale of unsuitable products. Incorrect approaches analysis. Recommending the universal life policy without a comprehensive suitability assessment, solely based on the client's stated interest, is ethically and regulatorily unsound. This approach risks misrepresenting the product's suitability and potentially violating Alabama's Unfair Trade Practices Act by engaging in deceptive practices. Proceeding with the sale solely because the client expressed interest, without ensuring they fully understand the policy's long-term costs and potential for lapse due to insufficient funding, constitutes a failure to act in the client's best interest. Another incorrect approach would be to push the client towards the most expensive version of the universal life policy to maximize commission, disregarding the client's financial capacity or actual needs. This prioritizes the agent's financial gain over the client's welfare, a clear breach of fiduciary duty and Alabama insurance regulations. Finally, assuming the client's understanding of complex financial products without verification is negligent and can lead to a sale based on misinformation, which is a violation of the agent's duty to provide accurate and complete information. Professional reasoning. Professionals should always prioritize a client's best interests, adhering to suitability standards and ethical conduct. This involves a systematic process of needs analysis, product education, and verification of understanding. When a client expresses interest in a complex product, the professional must go beyond mere acknowledgement and conduct a thorough due diligence to ensure the product aligns with the client's financial situation, risk tolerance, and objectives. If a mismatch is identified, the professional has an ethical and legal obligation to explain the discrepancies and propose suitable alternatives. Question 8. Compliance review shows that an employee in Alabama has inquired about coverage for a specific, potentially expensive medical procedure under the company's group health insurance plan. The employer's Human Resources Department has a general understanding of the plan's benefits, but is uncertain if this particular procedure is explicitly covered or if it falls under an exclusion. The employee is anxious about the potential costs and is seeking definitive reassurance from their employer. What is the most appropriate course of action for the employer's Human Resources Department to take? Option A. Advise the employee that the employer is not responsible for coverage decisions and that they should consult their insurance policy documents directly. Option B. Assure the employee that the procedure will likely be covered as it is a medical necessity, without waiting for confirmation from the insurance carrier. Option C. Delay responding to the employee's inquiry until the employer can conduct a thorough internal review of all policy documents, even if this means a significant delay in providing an answer. Option D. Immediately contact the group health insurance carrier to obtain a definitive pre-authorization or coverage determination for the specific procedure, while also informing the employee of the process and the need for official confirmation. The correct answer is D. Immediately contact the group health insurance carrier to obtain a definitive pre-authorization or coverage determination for the specific procedure, while also informing the employee of the process and the need for official confirmation. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires balancing the immediate needs of an employee with the legal and ethical obligations of the employer and the insurance provider. The employer is aware of a potential coverage gap for a critical medical procedure, and the employee is seeking reassurance and assistance. Navigating this situation requires careful judgment to avoid misrepresentation, ensure compliance with Alabama insurance law, and maintain trust with the employee. Correct approach analysis. The best professional approach involves transparently communicating the known limitations of the current group health insurance plan and proactively exploring all available avenues for coverage or assistance. This means accurately informing the employee about what the plan currently covers, acknowledging the uncertainty regarding the specific procedure, and immediately initiating contact with the insurance carrier to obtain definitive clarification. Furthermore, it involves investigating any potential supplementary coverage options or employer-sponsored assistance programs that might be applicable. This approach is correct because it adheres to the Alabama Insurance Code's principles of good faith and fair dealing, which prohibit misrepresentation of policy benefits and require insurers and employers to act honestly. It also upholds the ethical duty to provide accurate information and support to employees. Incorrect approach is analysis. One incorrect approach is to assure the employee that the procedure will be covered without definitive confirmation from the insurance carrier. This constitutes misrepresentation of policy benefits, a violation of Alabama Insurance Code provisions that prohibit false or misleading statements about insurance coverage. Creates a false sense of security for the employee, potentially leading to significant financial hardship if coverage is denied. Another incorrect approach is to dismiss the employee's concern and simply state that the employer is not responsible for coverage decisions. This fails to acknowledge the employer's role in providing and administering group health insurance and neglects the ethical responsibility to assist employees in understanding their benefits. It also ignores the potential for employer-sponsored plans to have provisions for exceptional circumstances or to facilitate communication with the insurer. Finally, an incorrect approach would be to delay contacting the insurance carrier, hoping the issue resolves itself or that the employee will not pursue it further. This inaction is a failure of due diligence and can be construed as a lack of good faith, potentially violating the employer's obligations under the group policy and Alabama law. Professional reasoning. Professionals facing such dilemmas should first prioritize accurate information gathering. This involves understanding the specific terms and conditions of the group health insurance policy. Next, they must communicate transparently with the employee, managing expectations while offering support. The employer's role is to facilitate understanding and explore all reasonable avenues for assistance, including direct communication with the insurance provider. A proactive and honest approach, grounded in regulatory compliance and ethical principles, is paramount to protecting both the employee and the employer from potential legal and financial repercussions. Question 9. Market research demonstrates that many seniors in Alabama are enrolled in both Medicare and Medicaid. An insurance agent is meeting with a prospective client who is 70 years old and expresses concern about out-of-pocket costs for prescription drugs and certain medical services not fully covered by Medicare. The agent knows of a specific Medicare supplement plan that offers robust prescription drug coverage, but it is a premium product with a significant monthly cost. The agent also knows that the client might be eligible for a Medicare savings program through Medicaid that could help with Medicare premiums and cost sharing. Which of the following represents the most ethical and legally compliant approach for the agent in Alabama? Option A. Immediately recommend the Medicare supplement plan with robust prescription drug coverage, highlighting its benefits and downplaying the complexity of other potential programs, as the client has clearly indicated a concern about drug costs. Option B. Advise the client that their Medicare coverage is sufficient and that supplemental plans are generally unnecessary, focusing instead on other types of insurance the agency offers. Option C. Focus solely on selling the Medicare supplement plan, assuming the client is already aware of and has explored all their Medicaid and Medicare savings program options. Option D. Fully explain the client's current Medicare benefits. Inquire about their specific concerns regarding prescription drugs and other costs, and then discuss how the Medicare supplement plan might address those concerns, while also exploring their potential eligibility for and benefits of a Medicare savings program to see if it could reduce their overall healthcare expenses. The correct answer is D. Fully explain the client's current Medicare benefits, inquire about their specific concerns regarding prescription drugs and other costs, and then discuss how the Medicare supplement plan might address those concerns, while also exploring their potential eligibility for and benefits of a Medicare savings program to see if it could reduce their overall healthcare expenses. Explanation. This scenario presents a professional challenge because it requires an insurance agent to balance the immediate financial needs of a client with their long-term well-being and adherence to regulatory requirements concerning Medicare and Medicaid. The agent must navigate potential conflicts of interest and ensure that advice provided is in the client's best interest, not just the agent's. Careful judgment is required to avoid misrepresentation and to uphold ethical standards. The best professional approach involves thoroughly assessing the client's current situation, including their eligibility for and utilization of Medicare and Medicaid benefits, and then providing comprehensive, unbiased information about all available options. This includes explaining how different insurance products might interact with or supplement existing government programs without creating unnecessary duplication or misleading the client about coverage. The agent must prioritize educating the client so they can make an informed decision, acting as a trusted advisor rather than a salesperson pushing a specific product. This aligns with the ethical duty of care and the Alabama Insurance Code's provisions against unfair or deceptive practices, particularly when dealing with vulnerable populations who may rely heavily on Medicare and Medicaid. An incorrect approach would be to immediately recommend a specific supplemental insurance policy without a full understanding of the client's existing coverage and needs. This could lead to the client purchasing redundant coverage, incurring unnecessary expenses, and potentially violating Alabama's regulations against misrepresentation and deceptive sales practices. Such an action prioritizes a potential sale over the client's actual needs and financial well-being. Another incorrect approach is to assume the client fully understands their Medicare and Medicaid benefits and to proceed with selling a policy without confirming this understanding. This demonstrates a lack of due diligence and could result in the client making decisions based on incomplete or inaccurate information, which is ethically problematic and could violate regulations requiring clear and accurate disclosure. Finally, an incorrect approach would be to steer the client away from discussing their Medicare or Medicaid coverage, perhaps by focusing solely on private insurance options. This is deceptive and fails to provide the client with a complete picture of their healthcare coverage landscape, potentially leading them to make suboptimal choices and violating the agent's duty to act in the client's best interest. Professionals should employ a decision-making framework that begins with a comprehensive needs assessment, followed by clear and accurate disclosure of all relevant information, including how proposed products interact with existing government programs like Medicare and Medicaid. Prioritizing client education and informed consent, while adhering strictly to the Alabama Insurance Code's mandates for fair dealing and avoiding deceptive practices, is paramount. Question 10. Cost-benefit analysis shows that Mrs. Gable, a 72-year-old resident of Mobile, Alabama, has a long-term care insurance policy purchased 15 years ago with a daily benefit of $100 and a 3% compound inflation rider. The current monthly premium is $250. She is considering a new policy with a daily benefit of $200, a 5% compound inflation rider, and a monthly premium of $450. Assuming a conservative annual inflation rate of 4% for long-term care costs, and that Mrs. Gable will need care in 5 years, what is the projected difference in the total benefit received over a 5-year care period between the new policy and the existing policy at the time care is needed? And what is the additional cost per year for this projected increase in benefit? Option A. The new policy is projected to provide approximately $219,000 more in total benefits over a 5-year care period, at an additional annual cost of $1,200. Option B. The new policy is projected to provide approximately $180,000 more in total benefits over a 5-year care period, at an additional annual cost of $1,200. Option C. The new policy is projected to provide approximately $180,000 more in total benefits over a 5-year care period, at an additional annual cost of $2,400. Option D. The new policy is projected to provide approximately $219,000 more in total benefits over a 5-year care period, at an additional annual cost of $2,400. The correct answer is D. The new policy is projected to provide approximately $219,000 more in total benefits over a 5-year care period, at an additional annual cost of $2,400. Explanation. This scenario presents a professionally challenging situation because it requires balancing the client's immediate financial concerns with their long-term health needs and the insurer's contractual obligations. The agent must navigate potential information asymmetry and ensure the client makes an informed decision that aligns with their best interests, while adhering to Alabama's insurance regulations regarding long-term care policies. Careful judgment is required to avoid misrepresentation or undue influence. The best professional approach involves a thorough, documented review of the existing policy's benefits, limitations, and premium structure, alongside a detailed assessment of the client's current and projected long-term care needs. This includes calculating the potential future cost of care and comparing it to the current policy's inflation protection features and the proposed new policy's benefits and costs. The agent should then present a clear, objective comparison, highlighting how the existing policy's benefits might be insufficient given the client's evolving needs and the rising cost of care, and how the new policy addresses these gaps. This approach ensures transparency, fulfills the agent's fiduciary duty, and complies with Alabama's Unfair Trade Practices Act, which prohibits misrepresentation and deceptive practices in the sale of insurance. Specifically, Alabama law requires agents to act in the best interest of the client when recommending a policy change. An incorrect approach would be to immediately push for the sale of the new policy without a comprehensive analysis of the existing policy's value and the client's specific needs. This could involve downplaying the benefits of the current policy or overstating the advantages of the new one without a factual basis. Such actions could violate Alabama's Unfair Trade Practices Act by engaging in misrepresentation or deceptive advertising. Another incorrect approach would be to focus solely on the premium difference without adequately explaining the corresponding changes in benefits, coverage triggers, elimination periods, and inflation adjustments. This failure to provide a complete picture of the policy's value proposition, especially concerning long-term care benefits which are highly sensitive to inflation and benefit levels, would be a breach of the agent's duty to inform and could lead to a client making an inadequate coverage decision. Professionals should employ a decision-making framework that prioritizes client education and informed consent. This involves 1. Understanding the client's current situation and needs thoroughly. 2. Analyzing all available policy options, including the existing one, with a focus on benefits, costs, and limitations. 3. Quantifying the potential future financial impact of long-term care needs versus policy benefits. 4. Presenting a clear, unbiased comparison of options, supported by calculations and documentation. 5. Ensuring the client fully understands the implications of their decision before proceeding. Question 11. Regulatory review indicates that an insurance agent in Alabama is assisting a client in purchasing a new product liability insurance policy for a manufacturing business. The agent is aware that the manufacturer of the product has recently identified a minor design flaw that is being addressed with a voluntary recall and modification program. The manufacturer's representative has asked the agent not to mention this issue to potential clients, assuring them that it is a minor problem that will be resolved before any claims arise. What is the most appropriate course of action for the agent to take? Option A. Advise the client to contact the manufacturer directly for information regarding the product defect, without disclosing the agent's knowledge of the issue. Option B. Proceed with the sale of the policy without mentioning the defect, relying on the manufacturer's assurance that the issue will be resolved before any claims occur. Option C. Immediately and fully disclose the known product defect and the manufacturer's recall and modification program to the prospective client, explaining its potential implications for their insurance needs. Option D. Inform the client about the defect but downplay its significance, assuring them that it is a minor issue that the manufacturer is handling. The correct answer is C. Immediately and fully disclose the known product defect and the manufacturer's recall and modification program to the prospective client, explaining its potential implications for their insurance needs. Explanation. This scenario presents a professional challenge due to the inherent conflict between a producer's desire to maintain a business relationship and the ethical and regulatory obligation to provide accurate and unbiased product information. The agent must navigate the pressure to downplay a known product defect while upholding their fiduciary duty to the client and adhering to Alabama's insurance laws. Careful judgment is required to prioritize compliance and client welfare over potential short-term business gains. The best professional approach involves immediately and transparently disclosing the known product defect to the prospective client. This aligns with Alabama's Unfair Trade Practices Act, specifically concerning misrepresentations and deceptive practices in the inducement of insurance contracts. Alabama law mandates that insurers and their agents act in good faith and provide accurate information. Failing to disclose a known defect, even if it's a minor one that the manufacturer is addressing, constitutes a material omission that could mislead the client about the true risk and coverage. This approach ensures the client can make an informed decision based on all relevant facts, protecting them from potential future disappointment or financial loss. It also upholds the agent's license and reputation by demonstrating adherence to ethical standards and regulatory requirements. An incorrect approach would be to proceed with the sale without mentioning the defect, hoping the manufacturer's fix will resolve the issue before it impacts the client. This violates Alabama's Unfair Trade Practices Act by engaging in deceptive practices through omission. It breaches the agent's fiduciary duty to act in the client's best interest and could lead to claims of misrepresentation or fraud if the defect later causes a loss. Another incorrect approach would be to inform the client but minimize the significance of the defect, suggesting it's a minor inconvenience that will be quickly resolved. While seemingly less severe than outright omission, this still constitutes a misrepresentation under Alabama law. The agent is not qualified to definitively assess the long-term impact or the certainty of the manufacturer's fix. Downplaying the defect prevents the client from fully appreciating the potential risks and making a truly informed decision, thereby violating the spirit and letter of the law regarding fair dealing. A further incorrect approach would be to advise the client to seek information directly from the manufacturer without disclosing the defect themselves. While encouraging client education is generally good, the agent has a direct obligation to disclose known material facts related to the insurance product they are selling. Shifting this responsibility without first providing the necessary disclosure is a dereliction of duty and a potential violation of Alabama's insurance regulations. The professional decision-making process for similar situations should begin with identifying any potential conflicts of interest or pressures that might compromise ethical obligations. Next, the professional must consult the relevant Alabama insurance laws and regulations to understand their specific duties and prohibitions. A thorough assessment of the facts, including any known product defects or limitations, is crucial. The guiding principle should always be transparency and the client's informed consent. If there is any doubt about the materiality of a fact or the appropriate disclosure, erring on the side of full disclosure is the safest and most ethical course of action. Question 12. Performance analysis shows that an insurance agent in Alabama is meeting with a prospective client who appears to be experiencing significant confusion and difficulty understanding the basic terms of a proposed life insurance policy, repeatedly asking questions that indicate a lack of comprehension of the coverage and premium obligations. What is the most appropriate course of action for the agent? Option A. Politely pause the application process. Express concern about the client's understanding and suggest they consult with a trusted family member or advisor before proceeding, while offering to answer any questions they might have after such consultation. Option B. Proceed with the application as planned, assuming the client will seek clarification from others later if needed, and focus on completing the sale to meet performance targets. Option C. Gently explain the policy terms again in simpler language, hoping that repeated explanation will eventually lead to understanding, and then ask the client to sign the application. Option D. Inform the client that their apparent confusion makes them ineligible for coverage and immediately end the meeting without further discussion. The correct answer is A. Politely pause the application process, express concern about the client's understanding, and suggest they consult with a trusted family member or advisor before proceeding, while offering to answer any questions they might have after such consultation. Explanation. This scenario presents a professional challenge because it requires an insurance agent to navigate a situation where a potential client's legal capacity to enter into a contract is questionable, directly impacting the validity of the insurance policy and the agent's ethical obligations. The agent must balance the desire to secure business with the fundamental requirement of ensuring the client understands and can legally commit to the agreement. Alabama law, like most jurisdictions, requires parties to a contract to have legal capacity, meaning they must be of sound mind and legal age to understand the nature and consequences of their actions. The correct approach involves a thorough and sensitive assessment of the individual's understanding and ability to make informed decisions regarding the insurance policy. This includes asking direct questions about their comprehension of the policy's terms, benefits, and obligations, and observing their responses for clarity and coherence. If there is a genuine concern about their capacity, the agent should politely and professionally suggest that the individual consult with a trusted advisor, such as a family member or legal counsel, before proceeding. This approach upholds the agent's duty to act in the client's best interest and ensures that any contract entered into is legally sound and ethically obtained, aligning with Alabama's principles of fair dealing and contract law. An incorrect approach would be to proceed with the sale without addressing the apparent cognitive concerns. This fails to uphold the agent's fiduciary duty to the client and risks issuing a policy that could be deemed voidable due to the client's lack of legal capacity. Another incorrect approach is to dismiss the concerns and assume the individual is capable, which demonstrates a lack of due diligence and a disregard for the potential consequences for both the client and the insurance company. Finally, pressuring the individual to sign despite evident confusion or hesitation is unethical and violates the principle of informed consent, potentially leading to exploitation and legal repercussions. Professionals should employ a decision-making framework that prioritizes client welfare and legal compliance. This involves active listening, careful observation, and a willingness to pause or seek further clarification when capacity is in doubt. The agent's role is not merely to sell a product, but to ensure the client is making a sound decision that aligns with their needs and legal ability to contract. When in doubt, seeking guidance from a supervisor or legal counsel is a prudent step. Question 13. Cost-benefit analysis shows that a particular homeowner's insurance policy in Alabama offers competitive pricing by covering only a specific list of named perils, with a broad exclusion for all other perils. An agent knows that the client is primarily concerned about damage from windstorms, which is a named peril, but also has a general fear of unforeseen events. How should the agent proceed to ethically and legally sell this policy? Option A. Clearly explain that the policy covers named perils like windstorms, but explicitly detail the all other perils exclusion and its implications, ensuring the client understands what is not covered. Option B. Assure the client that while the policy has exclusions, they can easily add coverage for any other perils later if needed, without detailing the process or potential limitations. Option C. Emphasize the coverage for windstorms and downplay the significance of the all other perils exclusion, suggesting it's a standard clause that doesn't typically affect most homeowners. Option D. Provide the policy documents to the client and assume they will read and understand the detailed exclusion section on their own. Correct answer is A. Clearly explain that the policy covers named perils like windstorms, but explicitly detail the all other perils exclusion and its implications, ensuring the client understands what is not covered. Explanation. Scenario analysis. This scenario presents a professional challenge because it pits the agent's desire to secure a sale against the client's potential misunderstanding of a complex policy feature. The agent must navigate the ethical imperative of full disclosure and client understanding against the business pressure to close a deal. Alabama law, like most insurance regulations, emphasizes the agent's fiduciary duty to the client, requiring honesty and transparency. Correct approach analysis. The best professional approach involves clearly and comprehensively explaining the policy's limitations and exclusions, specifically addressing the named peril coverage and the broader implications of the all other perils exclusion. This aligns with Alabama's Unfair Trade Practices Act, which prohibits misrepresentations and deceptive practices in the sale of insurance. By ensuring the client fully comprehends what is and is not covered, the agent upholds their duty of good faith and fair dealing, preventing potential future disputes and ensuring the client has appropriate coverage for their needs. This proactive approach builds trust and demonstrates professional integrity. Incorrect approaches analysis. One incorrect approach involves downplaying the significance of the all other perils exclusion and focusing solely on the named perils. This misrepresents the policy's scope and could lead the client to believe they have broader coverage than they actually do. This constitutes a deceptive practice under Alabama law, as it creates a false impression of coverage. Another incorrect approach is to assume the client understands the technical jargon and simply hand them the policy documents without further explanation. This abdicates the agent's responsibility to ensure client comprehension. Alabama law expects agents to act in the client's best interest, which includes facilitating understanding of policy terms, especially those that significantly limit coverage. A third incorrect approach is to suggest that the client can simply add on coverage for excluded perils later, without fully explaining the process, cost, and potential underwriting requirements. This creates a misleading expectation of easy and guaranteed future coverage, which may not be accurate and could lead to the client being underinsured. This is a form of misrepresentation regarding future policy benefits. Professional reasoning. Professionals should always prioritize client understanding and transparency. When faced with complex policy features, especially exclusions, the decision-making process should involve 1. Identifying potential areas of client confusion. 2. Clearly and simply explaining those areas, using analogies if helpful. 3. Confirming client comprehension through open-ended questions. 4. Documenting the explanation provided and the client's understanding. This framework ensures compliance with ethical duties and regulatory requirements, fostering long-term client relationships built on trust. Question 14. Cost-benefit analysis shows that purchasing separate flood and earthquake insurance policies in Alabama can be a significant additional expense for homeowners. A client, concerned about rising premiums on their standard homeowners policy, asks their insurance agent if their current policy adequately covers damage from floods and earthquakes. The agent knows that standard homeowners policies in Alabama typically exclude these perils, but separate policies are available. What is the most ethically and regulatorily sound approach for the agent to take? Option A. Assure the client that their current homeowners policy is comprehensive and likely covers most types of damage, including potential flood and earthquake events, to alleviate their premium concerns. Option B. Advise the client that only flood insurance is typically excluded and that earthquake damage is usually covered under their existing homeowner's policy. Option C. Inform the client that flood and earthquake insurance are generally not covered by standard policies and that they should consult the policy documents themselves for specific details. Option D. Proactively inform the client that their standard homeowner's policy likely does not cover flood or earthquake damage, and explain the availability and benefits of purchasing separate flood and earthquake insurance policies. The correct answer is D. Proactively inform the client that their standard homeowner's policy likely does not cover flood or earthquake damage, and explain the availability and benefits of purchasing separate flood and earthquake insurance policies. Explanation. This scenario presents a professional challenge because it requires an insurance agent to balance the client's immediate financial concerns with the agent's ethical and regulatory obligations to provide accurate and complete information regarding coverage options. The agent must avoid misrepresenting policy terms or creating a false sense of security, which could lead to significant financial harm for the client and regulatory repercussions for the agent. Careful judgment is required to ensure the client understands the limitations of their current policy and the availability of crucial supplemental coverage. The best approach involves proactively informing the client about the limitations of their standard homeowner's policy regarding flood and earthquake damage, and clearly explaining the benefits and necessity of purchasing separate flood and earthquake insurance policies. This approach is correct because it aligns with the Alabama Department of Insurance's regulations concerning fair and honest representation of insurance products. Specifically, Alabama law mandates that agents provide accurate information about policy coverages and exclusions. Ethically, this approach demonstrates a commitment to the client's best interest by ensuring they are fully informed about potential risks and available protections, thereby enabling them to make an educated decision about their insurance needs. An incorrect approach would be to downplay the risks of flood and earthquake damage, suggesting that the existing homeowner's policy offers sufficient protection. This is ethically unacceptable as it constitutes misrepresentation, potentially leading the client to believe they are covered when they are not. This action violates the principle of utmost good faith and could result in a claim denial, causing severe financial hardship for the client and exposing the agent to disciplinary action from the Alabama Department of Insurance for deceptive practices. Another incorrect approach would be to simply state that flood and earthquake insurance are not available without further investigation or explanation. This is professionally deficient because it fails to provide the client with complete information about available options. While standard homeowners policies typically exclude these perils, specialized policies are indeed available. Failing to inform the client of these options is a dereliction of duty and could be considered a failure to act in the client's best interest, potentially violating regulatory expectations for diligent service. A further incorrect approach would be to only offer flood insurance and omit any mention of earthquake insurance, or vice versa, without a clear understanding of the client's specific risks or preferences. This selective disclosure is misleading and incomplete. The agent has a responsibility to inform the client of all relevant coverage options that address potential catastrophic events, especially in a region where both flood and earthquake risks may exist, even if one is perceived as more immediate. The professional reasoning process for similar situations should involve a thorough needs analysis of the client's property and location, followed by a comprehensive explanation of all relevant insurance products, including standard policies and any available endorsements or separate policies that address specific risks. Agents must prioritize transparency, accuracy, and the client's understanding of their coverage. When in doubt about the extent of coverage or available options, agents should consult policy documents, company guidelines, and the Alabama Department of Insurance for clarification to ensure they are providing the most accurate and beneficial advice. Question 15. The control framework reveals that a homeowner in Alabama has requested a specific liability endorsement for their existing homeowner's policy, believing it will fully cover them against any potential lawsuits arising from a significant accident on their property. As an insurance agent licensed in Alabama, you know that while the endorsement offers some increased liability protection, a standalone umbrella policy would provide more comprehensive coverage for catastrophic events and is generally recommended for clients with significant assets. The client seems hesitant about the complexity and cost of an umbrella policy. What is the most ethically and professionally responsible course of action? Option A. Explain the limitations of the requested endorsement. Present the benefits and costs of a standalone umbrella policy as a superior alternative for comprehensive protection, and allow the client to make an informed decision. Option B. Process the requested liability endorsement immediately as the client has specifically asked for it, and assume they understand its scope. Option C. Recommend the liability endorsement because it is simpler to implement and will satisfy the client's immediate request without further discussion of alternative policies. Option D. Refuse to offer the endorsement, stating it is insufficient, and advise the client to seek coverage elsewhere if they are unwilling to consider an umbrella policy. Correct answer is A. Explain the limitations of the requested endorsement. Present the benefits and costs of a standalone umbrella policy as a superior alternative for comprehensive protection, and allow the client to make an informed decision. Explanation. The control framework reveals a common ethical challenge in insurance, balancing client interests with the insurer's obligations and the agent's professional duties. This scenario is professionally challenging because it requires the agent to navigate a conflict between a client's immediate desire for a specific coverage and the agent's knowledge that a more suitable, albeit potentially more complex, solution exists that better aligns with the client's long-term needs and the principles of sound insurance practice. Careful judgment is required to ensure the client receives appropriate advice and coverage, rather than simply fulfilling a request that might lead to future issues. The best professional practice involves thoroughly assessing the client's needs and explaining all available options, including their limitations and benefits, even if it means a longer or more involved sales process. This approach prioritizes the client's best interests and upholds the agent's fiduciary duty. Specifically, under Alabama law and general ethical principles for insurance producers, an agent must act in good faith and with reasonable care to provide advice and recommendations that are suitable for the client's circumstances. This includes understanding the nuances of different policy types and ensuring the client is fully informed about what their chosen coverage will and will not provide. Presenting the umbrella policy as a supplementary option that addresses the identified gaps in the homeowner's policy, while clearly explaining its purpose and cost, aligns with the duty to advise and the principle of utmost good faith. An approach that solely focuses on fulfilling the client's request for an endorsement without exploring alternative or supplementary coverages fails to meet the standard of care. This is because the endorsement, as described, may not provide the comprehensive protection an umbrella policy would offer, potentially leaving the client underinsured for certain catastrophic events. This could be seen as a failure to adequately advise the client of their options and the limitations of the requested coverage, potentially violating Alabama's Unfair Trade Practices Act if it leads to misrepresentation or deceptive practices. Another unacceptable approach is to dismiss the client's request outright without a thorough explanation. While the agent may believe the endorsement is insufficient, complete refusal without offering alternatives or explaining the reasoning behind the refusal can damage the client relationship and may not fully satisfy the agent's obligation to provide guidance. The client might then seek coverage elsewhere, potentially without the benefit of professional advice. Finally, recommending the endorsement solely because it is simpler to process, without considering its adequacy for the client's stated concerns about liability, is ethically unsound. The agent's primary responsibility is to the client's protection, not to the ease of administrative tasks. This prioritizes the agent's convenience over the client's well-being and could lead to a significant coverage gap, which is a breach of professional duty. Professionals should employ a decision-making framework that begins with active listening to understand the client's stated needs and underlying concerns. This is followed by a comprehensive needs analysis, exploring all relevant policy options and their implications. Transparency and clear communication are paramount, ensuring the client understands the coverage, limitations, costs, and alternatives. The agent should then provide a recommendation based on suitability and the client's best interests, allowing the client to make an informed decision. Question 16. Stakeholder feedback indicates that some agents in Alabama are recommending variable life insurance policies to clients who express a general interest in potential for growth, without a detailed exploration of their financial circumstances. An agent is meeting with a prospective client who has stated they are looking for an investment that offers some growth potential, but has not provided specific details about their risk tolerance or financial objectives. Which of the following represents the most appropriate course of action for the agent in Alabama? Option A. Recommend a fixed annuity instead, as it offers more predictable growth than variable life insurance and might be a safer bet given the limited information. Option B. Immediately present variable life insurance as a suitable option because the client expressed interest in potential for growth, highlighting its investment component. Option C. Focus the discussion on the tax-deferred growth features of variable life insurance, assuming this aligns with the client's desire for growth. Option D. Conduct a thorough needs analysis to determine the client's risk tolerance, investment objectives, and overall financial situation before discussing any specific product, including variable life insurance. The correct answer is D. Conduct a thorough needs analysis to determine the client's risk tolerance, investment objectives, and overall financial situation before discussing any specific product, including variable life insurance. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the agent to navigate the complex interplay between a client's stated financial goals and the specific regulatory requirements governing variable life insurance in Alabama. The agent must balance the client's desire for potential growth with the inherent risks and disclosure obligations associated with variable products, ensuring compliance with Alabama law and ethical fiduciary duties. Misinterpreting the client's needs or misrepresenting the product's nature could lead to significant regulatory violations and client dissatisfaction. Correct approach analysis. The best professional approach involves thoroughly assessing the client's risk tolerance, investment objectives, and financial situation before discussing specific products. This aligns with the Alabama Department of Insurance regulations concerning suitability and fair dealing. Variable life insurance is a security product, and its sale necessitates a comprehensive understanding of the client's profile to ensure it is an appropriate recommendation. This approach prioritizes client welfare and regulatory compliance by establishing a foundation of informed decision-making. Incorrect approaches analysis. Recommending variable life insurance solely based on the client's mention of potential for growth without a detailed suitability assessment is a regulatory failure. Alabama law requires agents to have reasonable grounds to believe that a recommended product is suitable for the client's insurance needs and financial objectives. Presenting variable life insurance as a guaranteed growth vehicle or downplaying its investment risk constitutes misrepresentation and violates the principles of fair dealing mandated by the Alabama Department of Insurance. Failing to provide a clear explanation of the variable nature of the policy, including the potential for loss of principal due to market fluctuations, is also a significant ethical and regulatory breach. Professional reasoning. Professionals should employ a client-centric, needs-based selling approach. This involves active listening to understand the client's full financial picture, risk appetite, and long-term goals. Before proposing any product, especially a complex one like variable life insurance, a thorough needs analysis and suitability determination must be conducted. This process should be documented to demonstrate compliance with regulatory requirements and ethical obligations. Question. Stakeholder feedback indicates that some agents in Alabama are recommending variable life insurance policies to clients who express a general interest in potential for growth, without a detailed exploration of their financial circumstances. An agent is meeting with a prospective client who has stated they are looking for an investment that offers some growth potential, but has not provided specific details about their risk tolerance or financial objectives. Which of the following represents the most appropriate course of action for the agent in Alabama? Options. A. Conduct a thorough needs analysis to determine the client's risk tolerance, investment objectives, and overall financial situation before discussing any specific product, including variable life insurance. B. Immediately present variable life insurance as a suitable option because the client expressed interest in potential for growth, highlighting its investment component. C. Focus the discussion on the tax-deferred growth features of variable life insurance, assuming this aligns with the client's desire for growth. D. Recommend a fixed annuity instead, as it offers more predictable growth than variable life insurance and might be a safer bet given the limited information. Question 17. The efficiency study reveals that an insurance adjuster in Alabama is handling a professional liability claim filed against a licensed architect. The architect's policy contains a standard exclusion for claims arising from intentional acts. The claimant alleges the architect intentionally deviated from approved plans, causing significant structural damage. The adjuster has received the initial claim notification and a preliminary statement from the architect denying any intentional misconduct. What is the most appropriate course of action for the adjuster to take in accordance with Alabama insurance law? Option A. Immediately deny coverage based on the policy's intentional acts exclusion, as the claimant's allegation directly invokes this exclusion without further investigation. Option B. Accept the claim and authorize payment based on the claimant's allegations and the architect's preliminary denial, assuming the architect is acting in good faith and that the claim is valid without independent verification. Option C. Acknowledge the claim but indefinitely postpone any substantive investigation or decision, stating that the adjuster is waiting for further clarification from the architect and claimant, without setting a specific timeline for resolution. Option D. Conduct a thorough investigation into the alleged intentional deviation, gather all relevant documentation, including blueprints, inspection reports, and expert opinions, and objectively assess coverage based on the policy terms and the findings, while adhering to the Alabama Insurance Code's timelines for claim acknowledgement and response. The correct answer is D. Conduct a thorough investigation into the alleged intentional deviation, gather all relevant documentation, including blueprints, inspection reports, and expert opinions, and objectively assess coverage based on the policy terms and the findings, while adhering to the Alabama Insurance Code's timelines for claim acknowledgement and response. Explanation. The efficiency study reveals a common challenge in professional liability insurance claims: the delicate balance between timely claim resolution and thorough investigation, especially when dealing with potentially complex coverage disputes. This scenario is professionally challenging because it requires an insurance adjuster to navigate the Alabama Insurance Code's provisions regarding fair claims practices, while simultaneously assessing the merits of a professional liability claim against a licensed professional. The adjuster must exercise careful judgment to avoid both undue delay and premature denial, which could lead to regulatory scrutiny and potential bad faith claims. The correct approach involves a comprehensive and objective evaluation of the claim's merits, supported by a thorough investigation and clear communication with the insured and claimant, all while adhering to the Alabama Insurance Code's stipulated timelines for acknowledging and responding to claims. This approach is correct because it directly aligns with the principles of fair claims handling mandated by Alabama law. Specifically, Alabama law requires insurers to act in good faith and to conduct a prompt and thorough investigation of all claims. By gathering all necessary information, objectively assessing coverage based on the policy and relevant Alabama law, and communicating findings clearly and promptly, the adjuster upholds their fiduciary duty and regulatory obligations. This proactive and diligent method ensures that the claim is handled fairly and efficiently, minimizing the risk of regulatory penalties and litigation. An incorrect approach that involves immediately denying coverage based on a preliminary, incomplete review of the policy and the circumstances is professionally unacceptable. This failure to conduct a thorough investigation violates Alabama's fair claims settlement practices, which prohibit insurers from denying claims without conducting a reasonable investigation. Another incorrect approach, which is to delay acknowledging or responding to the claim indefinitely while awaiting further information without a valid reason, also constitutes a violation of Alabama law. The Alabama Insurance Code mandates specific timeframes for acknowledging claims and providing responses or explanations for claim denials. Prolonged, unjustified delays are considered unfair claims practices. Finally, an approach that involves accepting the claim at face value without any independent investigation, solely based on the insured's assertions, is also professionally unsound. While cooperation with the insured is important, the adjuster has a duty to investigate and verify the claim's validity, to ensure the policy terms are met, and to prevent fraudulent claims, which is also implicitly required by the insurer's obligation to manage its reserves responsibly and in accordance with Alabama regulations. Professionals should employ a systematic decision-making process that begins with understanding the specific policy provisions and the applicable Alabama Insurance Code sections. This involves meticulously documenting all communications, investigations, and decisions. When faced with ambiguity, seeking clarification from legal counsel or senior management is advisable. The core principle is to act with diligence, fairness, and transparency throughout the claims process, always prioritizing compliance with regulatory requirements and ethical obligations. Question 18. The audit findings indicate a need to reinforce understanding of foundational insurance principles. An insurance agent in Alabama is explaining the purpose of insurance law to a prospective client who believes its primary function is to ensure insurance companies can operate profitably. Which of the following explanations best aligns with the core purpose of Alabama insurance law? Option A. The main purpose of Alabama insurance law is to allow insurance companies to operate profitably and generate revenue. Option B. The purpose of Alabama insurance law is to create complex rules that only legal professionals can fully understand. Option C. The sole function of Alabama insurance law is to dictate the specific types of insurance policies that can be sold in the state. Option D. The primary purpose of Alabama insurance law is to protect consumers by ensuring the solvency of insurers, promoting fair market practices, and providing mechanisms for redress. The correct answer is D. The primary purpose of Alabama insurance law is to protect consumers by ensuring the solvency of insurers, promoting fair market practices, and providing mechanisms for redress. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance agent to navigate the fundamental purpose of insurance law in Alabama while simultaneously addressing a client's misunderstanding. The agent must balance providing accurate information with maintaining client trust and ensuring compliance with regulatory intent. Misinterpreting the core purpose of insurance law could lead to misrepresentation, client dissatisfaction, and potential regulatory scrutiny. Correct approach analysis. The best professional approach involves clearly articulating that the primary purpose of Alabama insurance law is to protect consumers by ensuring the solvency of insurers, promoting fair market practices, and providing mechanisms for redress. This approach directly addresses the client's misconception by grounding the explanation in the foundational principles of consumer protection that underpin the regulatory framework. It educates the client on the why behind the regulations, fostering a better understanding of the insurance process and the agent's role within it. This aligns with the ethical obligation to provide accurate and transparent information, as mandated by principles of good faith and fair dealing inherent in Alabama's insurance regulatory environment. Incorrect approaches analysis. One incorrect approach is to simply state that insurance law exists to allow insurance companies to make profits. While profitability is a component of a healthy insurance market, it is not the primary purpose of the law from a regulatory perspective. Alabama insurance law is designed to ensure that profits are generated through fair practices and that policyholders are protected, not to solely facilitate insurer profit maximization at the expense of consumers. This approach fails to acknowledge the consumer protection mandate. Another incorrect approach is to suggest that insurance law's main purpose is to create complex rules that only legal professionals can understand. This dismisses the accessibility and consumer-centric nature that Alabama insurance law strives for. While regulations can be intricate, their underlying purpose is to provide clarity and fairness for all parties, including policyholders. This approach undermines the transparency and fairness principles. A further incorrect approach is to assert that insurance law's sole function is to dictate the types of policies that can be sold. While regulation does influence product offerings, this is a narrow view. The broader purpose encompasses solvency, market conduct, and consumer rights, not just product approval. This approach overlooks the comprehensive consumer protection and market integrity aspects of Alabama insurance law. Professional reasoning. Professionals should approach client inquiries about regulatory frameworks by first identifying the core intent and purpose of the relevant laws. This involves understanding the underlying principles, such as consumer protection, market fairness, and insurer solvency, as established by the specific jurisdiction statutes and regulations. When a client expresses a misunderstanding, the professional should gently correct the misconception by providing a clear, concise, an accurate explanation rooted in these foundational principles. This not only educates the client, but also reinforces the professional's commitment to ethical conduct and regulatory compliance. The decision-making process should prioritize transparency, accuracy, and the client's best interest, all within the bounds of applicable Alabama law. Question 19. The performance metrics show a pattern where some claims adjusters in Alabama are not consistently pursuing recovery from at-fault third parties after their company has paid an insured's claim. Which of the following actions best reflects the regulatory and ethical obligations of an Alabama-licensed insurance adjuster in such a situation? Option A. Sue subrogation aggressively against the third party without providing the insured with detailed information about the process or its potential impact on their overall recovery. Option B. Cease all subrogation efforts immediately if the insured expresses any discomfort or reluctance about the insurer seeking recovery from the third party. Option C. Ignore the possibility of third-party liability to avoid potential disputes with the insured and expedite claim settlements. Option D. Conduct a thorough investigation to identify any third-party liability, and if found, initiate the subrogation process in accordance with Alabama law, ensuring clear communication with the insured about the process and its implications. The correct answer is D. Conduct a thorough investigation to identify any third-party liability, and if found, initiate the subrogation process in accordance with Alabama law, ensuring clear communication with the insured about the process and its implications. Explanation. The performance metrics show a recurring issue with claims adjusters not consistently applying the principle of subrogation in Alabama. This scenario is professionally challenging because it requires adjusters to understand and act upon a complex legal right that benefits the insurer, but which can also impact the insured's recovery and relationships. Careful judgment is required to ensure the insurer's rights are protected without unfairly burdening the insured or compromising ethical obligations. The best professional practice involves a thorough investigation to identify potential third-party liability. Once identified, the adjuster should promptly notify the insured of the insurer's intent to pursue subrogation, clearly explaining the process and its implications for their claim. This approach aligns with Alabama law, which recognizes the insurer's right to subrogation after paying a claim, allowing the insurer to step into the shoes of the insured to recover damages from the responsible third party. This proactive and transparent approach ensures compliance with the insurer's right to recover its losses while keeping the insured informed, thereby upholding ethical standards of good faith and fair dealing. An incorrect approach involves failing to investigate for third-party liability altogether. This directly violates the insurer's right to subrogation as established under Alabama law. By neglecting this duty, the insurer forfeits its opportunity to recover funds paid out on a claim that was ultimately caused by another party's negligence or wrongful act. Another incorrect approach is to pursue subrogation aggressively without adequately informing or involving the insured. The insurer has the right to subrogate. Alabama law and ethical guidelines emphasize the importance of the insured's cooperation and understanding. Failing to communicate clearly about the subrogation process, potential delays, or how it might affect their net recovery can lead to disputes and breaches of the duty of good faith and fair dealing owed to the insured. A further incorrect approach is to abandon subrogation efforts solely because the insured expresses reluctance, without a proper assessment of the legal merits or potential recovery. While the insured's feelings are important, the insurer's legal right to subrogation is a contractual and statutory entitlement. A professional adjuster must balance the insured's comfort with the insurer's financial interests and legal rights, making an informed decision based on the facts and the likelihood of successful recovery. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the policy terms and relevant Alabama statutes governing subrogation. This should be followed by a diligent investigation of the claim to identify any third-party fault. Transparency and clear communication with the insured throughout the process are paramount, ensuring they understand their rights and the insurer's actions. Finally, decisions regarding the pursuit or abandonment of subrogation should be based on a reasoned assessment of legal viability and potential recovery, always adhering to the principles of good faith and fair dealing. Question 20. The assessment process reveals that an insurance company operating in Alabama in 1925, under the then-existing Alabama Insurance Code, collected an annual premium of $1,200 for a policy that commenced on July 1, 1925, and expired on June 30, 1926. Assuming the historical Alabama regulatory framework at that time mandated a simple pro rata calculation for unearned premium reserves at year-end, December 31, 1925, what would be the calculated unearned premium reserve for this policy as of December 31, 1925? Option A, $900. Option B, $1,200. Option C, $600. Option D, $300. The correct answer is C, $600. Explanation: the assessment process reveals a scenario that is professionally challenging due to the need to accurately apply historical principles of Alabama insurance law to a contemporary financial calculation. The challenge lies in understanding how early regulatory frameworks, which may have lacked the sophistication of modern actuarial models, influenced the development of reserve calculations, and how those historical methodologies, even if superseded, might still inform understanding of foundational principles. Careful judgment is required to distinguish between purely historical academic interest and the practical application of principles that shaped current statutory requirements. The best professional practice involves calculating the unearned premium reserve using the statutory method that was prevalent during the period when the Alabama Insurance Code was first significantly codified or amended to address such reserves. Even if more advanced methods exist today, this approach is correct because it directly addresses the historical development aspect of the question by simulating the calculation as it would have been understood and mandated under the relevant historical Alabama insurance statutes. For instance, if early Alabama law mandated a pro rata unearned premium reserve calculation for fire insurance, applying that specific formula to the given premium and term demonstrates an understanding of that historical regulatory requirement. This method respects the evolution of the law by focusing on the principles that were in place during the formative stages of Alabama's insurance regulatory history. An incorrect approach would be to immediately apply the most current, sophisticated actuarial methods for calculating unearned premium reserves without considering the historical context. This fails to address the core of the question, which is about historical development. It is a regulatory failure because it ignores the specific historical legal framework requested, and an ethical failure because it misrepresents an understanding of the historical legal landscape. Another incorrect approach would be to use a simplified, arbitrary percentage for the reserve that is not tied to any known historical statutory formula or actuarial principle from the relevant period in Alabama. This is professionally unacceptable, as it lacks any basis in regulatory compliance or sound actuarial practice, historical or modern. It demonstrates a lack of diligence in researching the specific historical requirements of Alabama insurance law. A further incorrect approach would be to calculate the reserve based on a general understanding of insurance principles without referencing any specific Alabama statutes or historical regulatory guidance. While the general principles might be sound, the question specifically asks about the historical development within Alabama's legal framework, making this approach insufficient and professionally deficient. The professional decision-making process for similar situations should involve: first, identifying the specific historical period or legislative milestone referenced in the question concerning Alabama insurance law. Second, researching the Alabama statutes and regulations in effect during that period that govern the calculation of insurance reserves, particularly unearned premium reserves. Third, applying the formula or methodology prescribed by those historical regulations to the given financial data. Finally, critically evaluating whether the chosen method accurately reflects the regulatory intent and actuarial understanding of that historical era in Alabama.